Welcome to EIS Navigator, the podcast for UK venture capital. I'm your host, Brian Moretta. After our successful basic series, we're back to normal programming for the podcast and delighted to restart with our usual year-end panel. An all-star group from all sides of the EIS and VCT industries discussed what happened in 2025, how recent events will affect the industry, and what will happen in 2026. If you join the podcast, don't forget you can subscribe through all good podcast services or players or following the link in the show notes. If you have any suggestions for future topics or guests, then you can email us at inquiries@hardmanco.com. Without further ado, enjoy our wonderful panel. I'd like to welcome everybody to the podcast. So we're joined by Kealan Doyle, who is the co-founder and partner at Symvan Capital. Ewoud, Karelse, who is the specialist in this area at Evelyn Partners, and very pleased to be joined at extremely short notice by Philip Hare, who is a partner at Philip Hare Associates. He has joined us because poor Christiana is in bed with the flu. So welcome everybody to the year-end podcast.
Thank you, Brian.
Thanks, Brian. Good to see you again.
Yeah, thank you for inviting me. I'm also chair of the tax committee of the EIS Association.
So we will be drawing on your knowledge very soon, Philip, because I think, after recent events, there are some areas that particularly play to strengths. But we're going to start with, with one of our usual topics, which is kind of the investment side of things. So I think a year ago, Kealan and I were kind of debating about whether we were past the bottom of the market or not. And I think we can probably agree that wherever we were a year ago, we're definitely past it now. Kealan, do you want to give us a perspective on the investing side of the market?
Last year was not a great year. I wouldn't say 2025 was brilliant. It's sort of counterintuitive that during COVID it was boom time, because I remember distinctly going into it how worried we were what would happen with the market, but it actually ended up being quite good times. But I do feel we're on the road to recovery in so many ways, and I know we're going to talk about AI quite shortly. That has changed a lot. There's a lot of I wouldn't say it's an overly enthusiastic market. Valuations have certainly come way down. I know a few years ago we were talking about how toppy they were, and that has largely changed. Although you could argue that in some cases AI valuations are a bit on the toppy side, but valuations in the market as a whole have come down. I think it's going to, bear markets don't last forever. You often, I think we're all of a certain vintage that we've seen ups and downs over many years. And I remember a few years ago at the top of the market, seeing people saying they'd never seen a bear market in tech stocks before. And I was like, okay, maybe that's why valuations are so toppy. So that has come back. Fundraising is still difficult in the EIS market. At least we found that, but a number of competitors I've talked to and colleagues agree with that. So are we past the bottom? Yeah, I think we are, but we're not in bull market territory yet.
Yeah,
would be
I don't know if
kind of analysis.
Philip are able to agree with that. Are we? Do you think we're on the way up?
It's very difficult to tell where we are. There's a lot of nervousness around, a lot of factors. There's uncertainty in the economy. Government strategy is not entirely clear on things. There's been a lot of speculation and leaks before the budget and so on. We see a lot of innovation. Necessity is the mother of innovation. So companies that come to us, we see some really great ideas that are being incubated and so on. So that looks good prospects for the future. But it's matching up those ideas and those businesses with the investors, and investors are keeping their hands in their pockets somewhat due to the uncertainty and the various tax changes that have happened.
Yeah. Do you have any perspective, Ewoud?
Yeah, so I can only look at obviously for my work, I will see valuations come in for the EIS managers that we work with, and they're pretty much flat at the moment still compared to earlier this year, which could be just very cautious managers that don't necessarily want to write their own or mark their own homework, which is good, because really valuations should be driven by new rounds as opposed to a feeling. So that's always a good sign. I have found that with our advisors and clients, there's definitely more interest again this year than we had last year, and last year it was better than the previous year, and that's entirely driven by other events in our clients' lives, in particular around pensions, and I'm sure we'll talk about that in more detail later, and then announced changes as well, specifically with landlords. So lots of activity in that space for our clients.
Yeah. I think one of the interesting things is there's been a suggestion, perhaps more in the States than here, that it's a bit of a K-shaped market. And we've already mentioned AI, which is didn't take very long. And I don't think we could have a conversation without mentioning AI in some sense, in that there is and the K-shape idea is that there's a feeling that AI to some extent is certainly PR terms is getting all the attraction, but it's also attracting a lot of investment. But perhaps other sectors are being somewhat left behind, either in flows or in valuation terms. I don't know if anyone's seeing any evidence of that.
Yeah, and I trust that's what you mean by a K market is you're either going up or down. Maybe AI cannibalizing other sectors. I think that's definitely true. I mean, I'll give you an example, a very concrete example. We have a company that we've invested in the area of AR, VR, which was a very hot sector a few years ago. And they're finding it very difficult in the AI onslaught, if you like, of attracting funds. And they've traditionally attracted a number of, really top funds. And they're finding that, everyone's talking about AI. But the other thing I noticed is that a lot of companies, there's a lot of hubris around AI. And those of us who remember other markets, there's some AI firms that are really savvy and technologically, robust and whatever, but pretty well everybody talks about AI now. It's really kind of overstated. And it's strange because it does remind me, and Brian, I know we've talked about this before, but we were both there for the internet boom. And if you remember the internet boom, most of the companies didn't work. But the internet, we don't even call companies internet companies anymore, do we? We used to call them internet companies. We don't, because it's ubiquitous. And the market was right in one way. And I guess if you harken back earlier, you could go back to the railway boom of the 19th century, where most investors lost money. And the internet was the same. But out of that emerged these giants that we know today, like eBay and Amazon, etc. And I think there's going to be a lot of carnage in AI. I'm not so sure if there's going to be a correction anytime soon in the public markets, because if people are talking about corrections, corrections almost invariably come out of nowhere, right? Or there's the straw that breaks the camel's back. When everybody's talking about AI overvaluation, it's probably got a bit more to run. But I do think there's a certain cannibalization. I do think that but there's some very real stuff happening, and one of the things we notice with our companies is if you're a computer program coder, your job outlook isn't as rosy as it maybe once was. I mean, there's definitely changes afoot. So it's real, but there's also a lot of hubris.
Yeah. I mean, Philip, you mentioned seeing a lot of business plans. To what extent do you see AI figuring in these business plans?
Yes, quite a lot. Most of what we see is technology of one sort or not, and increasingly AI is mentioned there. I don't pretend to understand it, but it looks great, but a lot of it. It does remind me of .com, when everything was .com at one point, and things are said they're AI, which possibly they're not really, but I'm not the best judge of that. Clearly, it's great. I love the innovation that people have and the ideas that they have and what AI can actually achieve. If it's directed in the right way and harnessed properly, I think it's actually beginning great for business, and the UK is a great place for startups.
Yeah. I think you're right. I mean, certainly from my perspective on something Kealan just said, and related to that, I think is, back in when we talked about the tech boom, everyone was started websites. Now everybody has a website. I think there's an extent that everyone will be using AI in some way in, pick a figure, 5 years, 10 years time. And in that respect, it will be a little bit like websites. There will be people like, OpenAI will see that, the picks and shovels sort of thing. But how is that actually, whether it's zero sum in terms of competition or whatever, I'm not really sure. Ewoud, to what extent are clients speaking about AI and interested in AI?
Well, it's not just clients. We ourselves are, as a firm, we have adopted AI to a large extent now. We are rolling out AI tools for our advisors, and some of the beneficiaries of that will be companies that started out as an EIS qualifying business. So that we already see that with our own company. I do think there's a big difference between AI first companies, or at least that's how they are how they are introduced to me as AI first companies. And here we find that there's not that much experience with some of the managers that are introducing those, or they have to be themselves specialized in AI for a long time. What we do see is a lot of EIS managers with tech businesses that are now AI enabled, where they've made use of AI tools. I'm sure, Kealan, you've probably seen that, well, both types of companies coming in your pipeline as well, I would imagine.
I think, it's interesting. I was talking about one of my companies that's an insurtech company. I was talking to a service provider for them, and I have a lot of programmers and coders and whatever. And they were saying, we got into a discussion about this because everybody uses AI to some extent, right? I don't know anyone who doesn't touch it, but for some, it's his point was kind of that you shouldn't lose focus on solving the client problem, and that just falling in love with technology for technology's sake is going down, a rabbit hole kind of thing. But there are definitely AI companies that are really, rather than a kind of general AI, really tailored towards solving problems. I think there is a differentiation, because I don't think anybody completely avoids AI. I may be wrong, but it's part of our lives now, isn't it? But there's definitely a differentiation between tech companies that are focused on, and very sophisticated AI that's proprietorial and are solving specific problems versus a sort of more general application of AI.
Yeah. So I think following on from one of Kealan's points is that I think, the question then arises is, and subject of much discussion out there is, are we in an AI bubble? Philip and Kealan, you've both mentioned analogies with what happened at the end of the last century. And I've probably seen a few myself. I don't know, Ewoud, do you see any of those?
I think there's specific sectors that are more impacted than other sectors. We've seen, obviously, the rise of AI tools in music, in art, and those were the first to go, almost. There's further AI in general automation, where we have already seen the introduction of robots in large warehouses, replacing people in warehouses. We're seeing AI replace call centers and contact centers. So there are a lot of sectors that are hugely impacted by this. There's now talk about some firms, law firms, putting or reducing the intake of juniors in favor of the adoption of AI tools. Mm-hmm. So those things are already happening. That will only escalate.
Yeah, graduate recruitment in the US apparently is weak, allegedly.
I think there seems to be a misperception in some ways that AI just came out of nowhere 3 years ago. It's sort of close cousin, machine learning. I think we invested in our first machine learning company in 2008, if memory serves. And, things have developed a lot since then, obviously. But Niall Ferguson, your fellow Scotsman, Brian, Stanford, I think he's a Stanford-based historian. He wrote an interesting article in the Sunday Times a few weeks ago about for a lot of people, AI is just an updated version of Google search. Now, I've been of the view that Google search has been kind of in decline for a while. But you remember when Google burst on the scene, we thought search had been solved, right? By like Yahoo and others like that, Ask Jeeves, and you remember these names in the past, and they kind of just stormed in. And I think, there's a certain perception that that's AI, which it is, but it's very different from some of the sophisticated stuff that's doing anything from risk management to manufacturing and there's still plenty to go. I mean, for instance, the marriage of AI and sort of visualization is some way to go before getting there. So it's so, as Ewoud said, there's different sectors are affected differently. But in terms of your original question about a bubble, I think when you see, there was a survey I saw a week or two ago. I think it was selecting a FTSE 100 companies, and most of them hadn't seen everyone spent a lot on AI, but very few saw a discernible productivity impact. And if that's going to continue, and I don't think it will, again, it's back to Ewoud's point about different sectors, but in aggregate, if that's going to continue, then there's going to be a correction. Because they're pretty frothy, a lot of these stocks.
Mm-hmm. Yeah. So if I did a quick run around the panel and sort of said, if we take the analogy with the last tech bubble, so in 96 we had Greenspan saying, right, irrational exuberance. 99 was probably the last year of exuberance. 2000 was the bust. Where do you see AI being in that, or is that the wrong analogy? I'll start with Philip.
Yeah, I'm not personally the best person to answer this, but I do see a lot of so-called AI. Say it's a bubble. I mean, that can do two things. It can fly or it can burst. And I think it's going to do a mixture of both. So, I mean, there's going to be some fantastic things, a lot of labour-saving things, as already been mentioned. But some of it's going to be, well, there's no point in having that at all. And there are certain industries where you definitely need human intervention. So I think it's going to be a mixed bag, a bit like we've had it in these sort of places before. It's going to learn from itself as well, and people are going to think of more things, and that innovation is great, and it drives the growth which we're all looking for.
Yeah. Ewoud, where do you think we are?
Well, I think if there's a few items that need to be solved, I think, for AI to continue to grow rapidly. And one is energy, also water, basically as a cooling mechanism. So those two are basically infrastructure that needs to be sorted. At the same time, I think a lot of companies, because they've started using AI, the more adoption you've got of AI with companies, it currently is relatively cheap to use AI. So if that catches up quick enough, then I think it could become a sustainable ecosystem. But I would imagine there will be one or two large losers, similar to the .com boom and bust. And that goes for all the tech companies, the infrastructure companies that were working in those days as well. There's been a huge shift. Some of those companies don't exist anymore.
So, Brian, your analogy is particularly painful for me because back in my youth, when that was all happening, I shorted the U.S. stock market, probably about halfway through that your intervals there, and my put options expired just before the crash came. So I was right, but got the timing wrong. And I think since then I'm loath to ascribe time values to these things and just more look at. I mean, I found this a few years ago. We turned away so many companies because of valuations. And I was just like, venture is hard enough to make money anyway without overpaying dramatically. It's worth like 3-4 times what they should have been, like what we thought they were worth. They get the deals away. No, I don't think those people have made money. In fact, they probably lost money. But you see it time and time again. And I'm loath to predict exactly when this has happened, like, oh, there's going to be a correction in 6 months' time or whatever. But there will be a shakeout, and it'll be classic creative disruption. Some will be real winners. Some will be, go to the wall. But when that happens, I don't know.
Yeah.
But it's inevitable that it will happen.
Absolutely.
There will be a shakeout at some point.
I mean, to me, it still feels a bit more like 96 than 99, but that's that's worth what you paid for it as a recommendation. Next thing I'd like to ask about in this area is exits, because one of the good news stories, admittedly not hugely, but we did see a return of exits in 2025. And I don't know if anyone's got any observations on that and how strong that they feel that trend is.
I think they're going to be increasingly coming back. People have definitely been fussier. But we had a pretty good exit, actually, Ewoud, to a Dutch company this year. And a blockchain digital custody platform. We almost had another one, but it fell apart at the last minute, unfortunately. But that wasn't due to valuation or bearishness. It was more the personality clash between the acquirer and the acquiree. So there's definitely activity happening. We've got another one. Well, I'm told before Christmas, but I'm kind of doubtful about that now. So yeah, it's happening. I mean, they're kind of died for a while. I think it is. I think generally the market is coming back. It's just not racing back. It's kind of rising, but slowly. And Nexus is part of that.
Yeah. I see Philip nodding his head in agreement there.
Yeah, I think what's happened is there's been a dose of reality, because obviously valuations were a lot higher a few years ago, and now I think people are accepting that they were unsustainable. So people are willing now to exit at a lower valuation than perhaps they first expected. I think that's what's happening. It's coming through more steadily rather than at a rush. But I think sensible decisions being made, and it's good to have these transactions increasing.
So you think part of the stall in 22 and 23 was not so much acquirers not willing to pay, but actually vendors thinking their companies are worth too much?
Well, I think that there was COVID. Everybody expected everything to be doom and gloom, but actually it wasn't. It was actually again a mother of invention. People, how to deliver things remotely and so on. People, there were some businesses that were really waiting for that and really prospered on that. And I think it led to an expectation that there was large growth in the economy and values, so when it perhaps wasn't quite as strong as that in reality. So it's taken a while for people's mindsets to adjust back to what the norm should be.
Yeah. No, that's fair. Well, we hope that trend will continue.
Several of the funds that we have with our clients, they've reported exits during the year, and that's always good to share with other advisors in the firm. Mm-hmm. It's been a good news story. There's obviously been a couple of failures as well, obviously. So, but that's the beauty of a portfolio approach.
At the end of the day, all EIS and VCTs exits is the name of the game at some point. But there seems to be, and maybe this goes back to limited life EIS, which you could exit in 3 years. It's impossible to determine. Mm-hmm. I mean, I've had more fall apart than happen. But throughout life, that is. If you look at an institutional PE fund or sort of later stage VC fund, which you'd expect to have an exit earlier, they tend to be a life of 10 years and often with a 2-year extension. Mm-hmm. I was noticing a rating, like a reviewer of funds in this space, and they had. We said our expectation, there's a concept in fixed income called average life, and we kind of use it. It's not perfect, but we sort of say that our average expected life of an exit is 7 years. So sometimes, like this company that we sold, the SCIS and the first tranche of EIS, that was about 5 years old, the SCIS, and maybe 4 years for the EIS. But sometimes we sold one the year before, it was 9 years. It's really hard to tell when you send them. But I think, the reviewer that we're going through this because we're correcting a review or editing or whatever, and the market has a target expectation. And Philip and I, our colleague on our last call mentioned this, a target exit of 4.5 years. Well, if that's supposed to represent when your portfolio is exiting, that's totally unrealistic. And I think even average life of 7 years is, whatever. I think it's more or less right, but it's very difficult to say. But I do think that rating people who rate on panels and whatever for wealth managers should also look at failures. That's an exit.
Yeah,
I don't know if Ewoud agrees with that.
Oh, 100%. 100% is an exit. There's also tax implications, and that's an exit. So for me, what I would say to our advisors and what they can tell our clients is that I expect an average hold for early stage businesses 8 to 10 years, just the average. Some will be sooner. That could be a lemon. That could be an early success. But 8 to 10 years, that's for EIS. I would expect SES to be 10 years plus.
Yeah. I tell people, if you think about EIS, it's a 10-year investment. That's what you got to think about, regardless of these averages. Because even if you get, say you get 6 or 7 years as the average, the reality is the first 2 or 3 years, by number of companies that might be right, but the first 2 or 3 years are going to be the failures, for which you get little or no cash. And chances are the exit of 10 years is going to be worth more than the successful exit of 5 years. So in money weighted terms, even if the average company lifespan of holding is 6 years, money weighted average is going to be close to that decade.
Well, we have, and this is another thing to factor in, as you said, that where the value is and trying to judge that. We have a company that I'm going to say we probably first invested 6 years ago. And we were planning to sell it this year in 2025. And we engaged in a well-known investment bank last year in 2024. They put together a target list and they said, you have to hit these revenue targets and this growth target and whatever. And we think we can get circa 50 million for you. Mm-hmm. That was music to our ears. But anyway, they said to us and probably to an American company, actually, was where most of the targets were. But there was a few. There was a Japanese and there was a German and whatever. But they said to us mid-year, they said, with a bit more money, we think in 2 years, 2.5 years, we could be seeing a value of 250 million, which is significantly higher. And, I'm not saying they're going to be right in that assessment, but they still are doing well. So I'm hoping they get somewhere near there. But that kind of decision, like you're tempted after 6 years, it'd be nice to have an exit on the company. But if we sell it for that much more in 8 years, is that a good trade? I'd say yes. Even twice the amount, I'd say yes. Let alone 5 times the amount. So it's really hard to gauge. And of course, we could all be wrong.
Mm-hmm. Yeah, and we frequently are. I'd like to move on to fundraising. So I think Kealan mentioned earlier it's been a tough market out there in EIS. Ewoud, you're on that side of things. What are you seeing?
Well, we see definitely more interest. We've seen a big increase in SCIs this tax year, which is really good to see. EIS also more popular again, and that's entirely driven by the other announcements by the government on the treatment of pensions. So a combination of pension rules changing and in some cases, viability of landlords retaining their properties in the face of a lot of new laws coming in and higher taxes for them coming in. So we see the combination of people selling properties and taking money out of pensions to create an income tax charge. So they have a capital gain to defer or to reinvest with an SCIS, and an income tax to offset when they take money out of a pension that would otherwise be unused. So caught by the inheritance tax trap. So that's a perfect storm in that sense, a positive storm for the use of SCIs and EIS.
Yeah. Philip, do you see much on this side?
Yes, I agree that there is some increased amounts of investment there. There's still nervousness generally. People have been taking money out of their pensions, but not all of it gets reinvested in things. It gets passed down the generations, or people spend it. They might as well spend it rather than it stay in their pension and then be taxed later on. I think, again, there's a bit more of a dose of realism, so that whilst people were keeping their hands in the pocket, they're a bit more willing now to invest at the right opportunity. Interest rates coming down a little bit, and that's on the move down. It's also moving things away from your sort of fixed interest type investments. You can get a reasonable return still on gilts if you know what you're doing, but actually you'd rather like people to take more risk investments into the companies. It's happening a little bit. A lot more could be done. I would hope that with the increased limits on what companies can receive, now people are more willing to invest under the EIS and scale-ups as from next year. I think that will be a positive.
Yeah, that's definitely a positive. And I think it'll be interesting in VCTs in particular this year, because I think the 24-25 tax year was down not quite 20%, but in nearest zero. We saw $1 billion take 800 odd. Yeah.
So VC investment did fall a bit. We had some quite good years. I mean, it was still quite a good year actually compared with average. But what will happen with the income tax relief for VC investment going down to 20% from the 6th of April, there will be more VC investment than we would have expected this year. It will be a kind of last petrol before motorway type scenario. Then after that, I think some of the smaller VCTs might struggle to raise money in the future. The larger ones might still raise some, but perhaps not at the same level. It's a great shame, because that would mean there's less funding available in VCTs to invest in the young companies and the scale-ups as well. The Treasury say they didn't expect that there'll be a drop in VCT funding, but I think that's unrealistic, somewhat naive assumption. They might think that some of that money is going to go into EIS. I doubt whether a great amount of it will. It's a completely different investor base for VCTs than it is for EIS. VCT investors are quite democratic. They're not all high rate tax buyers by any means. Quite small sums are put into VCTs yearly by retail investors, whereas the EIS investment tends to be more your angel type investors, so people more business focused, larger checks going into those companies. I mean, there's crowdfunding as well. It's very small amounts, but I'm talking about the main EIS investments tend to be larger sums. People willing to wait a longer time to get a return on those investments.
Yeah. So I think I'm sure every listener already knows, but the Chancellor in the budget announced that VCT income tax relief will be reduced from the next financial year, or start of next financial year, so that'll be 6th of April, from 30% to 20%. And I think my perspective is that's an effective halving, because anyone who buys a VCT, you got 5% cost and you got 5% bid offer spread. So 10% of your relief was effectively going on other things. So your net relief is being cut from sort of 20 to 10. So I think that is a very significant relief. I think my take on the season to date was that it was kind of steady, but nothing spectacular. So probably, I don't think it was quite as strong as last year, but it was kind of in that ballpark to date.
Yes, it was going quite steadily this year. The expectations we wouldn't reach the amount that was invested last year in VCTs. I think now more VCTs are going to go out there and raise more money while they can under the 30% regime, and possibly not raise money the following year.
Yeah. I mean, there's one big swing factor, which is, of course, the largest VCT is still out of the market, and that was a very big fundraiser.
I'm expecting activity from VCTs that weren't planning, and I'm expecting activity from VCTs that are already out to increase.
So you think people will increase existing offers, or even there's one or two offers that have closed. Do you think we might actually see a sort of second swing at the bat?
Yeah, so there's been an RNS, so I can talk about that publicly, but the Northern VCTs have issued an RNS to that extent. that they would want to extend the over-allotment facility.
Yeah, that doesn't really surprise.
I still think for advised clients, especially advised clients that are looking at larger checks, they tend to be larger than sort of retail clients on self-select. I would still expect the advised clients to continue to invest in VCTs, given the changes in taxation coming over the horizon. So it becomes even more important to think about alternative retirement planning using VCTs, as well as just managing the fact that some investments, the dividend tax is going up, savings tax is going up. So it makes sense to have a income tax-free, dividend tax-free vehicle like a VCT. If you're that sort of client that would have otherwise have been attracted to that already, from an income point of view. So I'm less pessimistic, albeit I share the I don't share the optimism of HMRC that it won't have any effect.
Yeah. Kealan, you wanted to say something?
Well, I agree with that. With what Philip was saying about VCT being, and for that matter, and it's a different product than. I mean, if I look at most of our investors, they tend to be people selling businesses, or maybe investment bankers, or people who understand risk. And I think VCT was traditionally, maybe, as Philip said, more of a retail market, and that some of that, who knows what the effect is. I know last time they changed with VCTs, there was quite a drop off in demand, but that money won't necessarily come into EIS. I think probably some of it will leak in, because there's some financial advisors out there who feel much more comfortable with VCTs than EIS. I mean, I always say in investor presentations, well, not always, but often, that I think you should be in this asset class irrespective of the tax breaks. But if we're honest, and it should be a small part of your diversified portfolio for a wealth manager, but an important one. It should be the highest performing one. And but honestly, without the tax relief, there wouldn't be anywhere near the demand for EIS or VCTs. I think we all know that. So there will be some people who I think migrate to EIS. I don't think it'll be a negative for EIS, but there'll be some people who just don't do tax efficient investing, I'm sure.
Yeah. I think it's very clear. I mean, if you look at what the Chancellor did in the budget and the last couple of budgets, they have made pretty much everything else less attractive. They've I mean, and no one's going to move from cash ISAs to VCTs or EIS, but cash ISAs are pensions are, I mean, you saw the cut in, not just the income tax, but also salary sacrifice got limited. So other things are less attractive. And if you sort of say, well, if you're not saving your income tax, getting income tax from VCTs, even at 20%, where else can you go to get that? And the answer is, well, if you want to move to EIS, possibly, but the alternatives seem a bit limited on the ground to me.
Yeah, very much so. But I think the other thing that's worth noting is that because both for VCTs and EIS, there was good news in that budget. Not for many people who are savers, but for companies in particular, that they can raise a lot more money.
Yeah. Well, Philip, Philip, do you want to summarise what the good news in the budget was?
Yeah. So on the positive side, and it is positive, that the limits that apply to companies receiving EIS and VC money are going up, and effectively they are doubling. So some of these limits have been in place for many years. So there are gross assets limits, and the VCTs have had this limit for a long time. EIS not quite so long. But at the moment, a company has to have gross assets of no more than £15 million at the date on which they issue shares. That's going up to £30 million as from the 6th of April for investors made on after that date. Now, obviously, inflation has eroded the value of that limit. Plus accounting changes mean that people have to capitalise things more than they used to. So companies which would have qualified even under old accounting rules no longer do so. But this will help those sorts of companies. So it will help scale up so slightly larger companies can qualify. The the other side of it is that since 2015, when the EU imposed limits on us, then there have been annual and lifetime limits that a company can receive from tax advantage sources. So they are being doubled as well. So at the moment, an ordinary company, non-knowledge intensive company, can receive up to £5 million on a rolling 12-month basis. On a lifetime, £12 million. They're doubling to 10 million on an annual basis, 24 million on a lifetime basis. And then for the knowledge intensive companies which are doing a lot of R&D work, a lot of R&D costs, their limits are going up from an annual basis of 10 million to 20 million pounds, and a lifetime from 20 million pounds to 40 million pounds. All very welcome. For some industries, that's really helpful. Some industries, it's still not really, more could be done with. Some of your life sciences, heavy engineering, the sort of growth sectors that the government actually wants to support. Higher limits would actually be more helpful, but we have to be glad for what we have got. Just one caveat that Northern Ireland companies trading in goods do not benefit from these increased limits. The reason for that, according to the Treasury, is that they are subject to they can access the single market, and it's assumed that they will trade across the border with the Republic. In my view, under the Windsor framework, Northern Ireland can have the same rules as Great Britain, so long as its cross-border trade is not skewed. And the number of companies receiving tax advantage money in Northern Ireland is probably not sufficient to skew the cross-border trade, in my view. But they're obviously being very cautious at the Treasury.
Mm-hmm. Yeah, I think the tone of the government is to be more to look towards having a better relationship with the EU than perhaps we had under the last government. So I think you can understand if they want to perhaps tread carefully on that. Kealan, do you think this is going to make a big difference?
Do I think what's going to make a big difference, Brian?
These new increased company limits.
Hey, discussed this with Philip before. I think the concomitant move should have been to also increase the time limits, because for knowledge intensive, we're limited to 10 years. Because the whole, as we explained in the budget, it's you don't want companies going off to, say, America. Like you run into this limit and you're really growing quickly, and that seemed to be the rationale behind it. But presumably, if you're allowing that much more to be invested, you should also increase the timeline. So I was a bit confused by that. I think that sort of offsets the impact. Not in all cases, obviously, but in some. But some companies, they've become very exciting companies, but it takes a while to get there. It takes longer. I mean, almost any budget any forecast we look at, we take with a large grain of salt. Because it just invariably, the curve is kind of more like that, and then it goes up. I think by experience, if you're going to increase those limits, you could also think about increasing the timeline. Mm-hmm. But maybe that's a future budget.
Maybe. Ewoud, do you got any thoughts?
I suspect that there may be, and Kealan, you'd be interested in your view on this. I suspect to be quite a few EIS managers, as well as the VCT managers, that will be able to follow their money more than previously. And so I'm wondering to what extent what effect will that have on clients' portfolios, with more money going into existing portfolio companies and not for new companies.
There is a danger, I think, with the lowering of the VCT tax rate. The VCTs will concentrate on their portfolio, partly because they will have reduced funding. They won't receive as much money. That's partly that. And also, investors might put pressure on them to invest only in larger companies rather than small ones, because the risk-reward ratio doesn't work anymore. So I think there's been a misunderstanding at the Treasury of actually how the tax reliefs work and how that incentivises VCTs to invest in the right sort of companies.
Yeah, I mean, my gut feeling is it's more of a VCT than an EIS issue in some way. That if you look across, the 70 odd EIS funds, I suspect there are very few of them that would, if previously Series B was, say, the cap, could they participate in a C and a D? Well, they might get the pro rata, but they're not. Very few EIS funds are going to be able to actually make meaningful contributions to C or D rounds with the amounts that they're raising. there's a handful that will. So I think it really is more of a VCT than an EIS benefit.
There's an interesting point then with some of the VCTs. I would expect there are VCTs because they invest earlier stage than so some of the newer VCTs invest earlier stage. I'd expect them then to benefit in a way for people who are looking for further or a higher growth than the average VCT. So that would be an interesting differentiation in the VCT market. And I would also expect then there be some EIS managers who will be tempted to also go for the larger companies, and maybe like with revenues well over $1 million. And again, that would create opportunities for newer EIS managers and for more nimble EIS managers to go earlier stage again.
Kealan, you got any more thoughts on that?
Not really. I think everything's been said that I think is salient at this point. But I totally agree with what you say, that it's more than an impact on VCT than EIS.
Mm-hmm. Yeah. Philip, you were making a point earlier about AIM. Do you want to maybe explain why this could actually be a positive for AIM, which is, I think we're desperate for any positive in AIM at the moment.
Yes, sadly, there haven't been that many new companies coming to AIM recently, all kinds of reasons, really. And in the past, it has been VCT and EIS investment, and particularly VCTs, that have cornerstoned new listings on AIM. Without it, actually, then some companies just wouldn't be there. So I've been talking to brokers. They're very excited, actually, about the new limits that will apply from April. So larger companies will qualify. So there hopefully will be some new entrants to AIM, which we all need, but also some companies which are already on AIM, which haven't been able to raise EIS or VCT money before, may be able to do so now with the increased limits, provided they meet the age test, which Kealan was talking about. Mm-hmm. And also, of course, some companies which are on there and did receive the EIS and VCT money in the first place and have run out of limits, now may be able to raise some more money and then grow further. So it's good news for AIM. And I hope that brokers who are excited by it will actually go and find out these companies and encourage them to come and raise money in this way.
Yeah, I would second that.
I think that would be great if it did help AIM, because I think that would, AIM is just a shadow of where it was 20 years ago. I used to do a lot of IPOs on AIM, and it's nowhere near where it was. And it would be just a great outlet for further exits and allow different investor classes to get in and provide exits for people at the SAS level, the EIS level, or VCT level. So if it's going to have that positive impact on, I mean, it's no secret that London's capital markets are, it's not the glory years, is it? So anything that can help that is going to help the entire ecosystem.
Yeah, I've already spoken with some AIM VCT managers who are very excited. And also an EIS manager who's looking at using an AIM EIS because of the changes. So it'll be very interesting to see whether they come to market, because, it's good to get some alternatives.
Yeah. We've seen a couple of products pull out of the AIM market effectively in the last couple of years. So yeah, it would be good to get something coming back the other way. So the next question I want to ask about is, where has ESG gone? And this is something based on my observation, in that, and this may be a function of AI, nobody seems to be talking about ESG anymore. And I don't know if that's because it's seen as something that's settled, or it's just that it was flavour of the day and moved on. Where has ESG gone?
The way of the dodo bird, hopefully. I think I'm a big believer in what Milton Friedman said, that companies exist to provide shareholders with returns. You have politicians to introduce stuff, with the exception of the part of ESG that's neglected, which is the D. The G is when people think of ESG, they think of E and S. They don't really think of G, unfortunately, because G is what really helps the shareholders. But it's hard enough to make money being stocks without. I don't think companies should be given. There's a lot of virtue signaling going on. and yeah. So to me, I'm glad that this trend is over. That's something controversial to some, but it's good riddance.
Well, I agree with you to an extent, because I think it was taking up energy which could have been used elsewhere better. Everybody should consider their social impact and so on. And so I think it was good to have it raised, but it probably was overdone. I think it's a natural, it's almost like it doesn't have to be talked about because people are doing it generally. So, so I don't think it's over at all. I just think it's now the norm, but perhaps at a better level.
Yeah, I see quite a few funds invest in B Corp companies. So those are companies clearly that live and breathe ESG. There's still a couple of specialist funds that look at impact. And there are still clients, obviously, that quite like the idea that their money is invested in successful businesses, but where there's also something that allows certain communities to be uplifted in that sense, or not be penalized. And we all know that if you live on a council estate, your insurance premium is probably higher than if you don't live on a council estate, right? So you get a poverty premium, and if technology can solve that, that's great. And that technology could probably be monetized quite successfully for other communities as well.
Mm-hmm. Yeah, that's probably fair. I think it's always a bit strange for the venture industry, because coming back to Kealan's point, into my mind, the key role of venture capital is to introduce governance into companies. It's kind of, they stick somebody on the board to make sure the reporting structures are in place. They sort out financial report, all those sort of things. It's kind of a key strength, or it's almost the essence of venture capital. And I don't think venture capital ever did, certainly EIS industry, ever did a really good job of actually articulating that. And that's partly because, again, the point, key point, if you say people what they're interested in ESG, they're really interested in everyone's environment, social side. Yeah, a lot of people interested in that. No one really cared as an investor about the G, despite the fact it's actually really important.
Well, the G makes the company ready for takeover, right? Ultimately, or flotation, or it's an exit mechanism as well. If the company's ready with all their systems and structures, proper governance, it becomes an investable company as well for later stage investors.
So yeah, and I think the impact, there's always going to be a demand for impact. I think that's right. There are some impact specialists out there. I think I mean, I'm going to disagree with the Kealan that I think you need a basic level of ESG. I think I think you need consideration that somewhere down the line, we're not going to trash the environment in particular. I think there's an issue out there. Now, how that gets articulated in an early stage company, you can discuss that a lot. I think, you could easily get too heavy handed, but I think there is a need for that to factor in there. And, one of the things in the back of my mind about AI is that AI is kind of almost the anti-ESG in some ways. You could make the argument it's got an big environmental impact. It's going to disrupt things socially. And goodness knows what's going on governance-wise in the States. So, but that's my perspective. So, we've chatted a lot about 2025. Let's look forward to 2026. How do we think things look for next year?
Well, we've got these increased limits as from April, which must be a good thing. For further investment in our growing businesses in the UK, so that's got to be good news. We've got to spread the word that these reliefs are available and larger companies can qualify. So it's incumbent on all advisors and intermediaries to do that. There's also, by the way, a consultation going on about EIS and VCTs, partly because of things that the government knows about it and what's been in the press about them. So they're assessing what are they doing, can they do more, what things perhaps need to be changed about them. So I particularly invite entrepreneurs to look at that and to, especially if you've had the benefit of EIS or VC investment, to say how worthwhile it was, what you got from not just the funds, but also the expertise that went with it. So the VCT or EIS manager that actually came and helped grow that business with you. I think that would be very worthwhile if people could participate in that consultation, and hopefully that will lead to more positive changes to these rules in the future. But in terms of, we've been sort of bumping along the bottom for a bit in terms of the economy, interest rates beginning to come down a bit. I think that's sort of going slowly in the right direction, and hopefully the confidence will come back. If we can get a sense of stability and what the government's real strategy is, I think that will help also for the future.
Hopefully. Ewoud.
I think the continuation of the impact basically of the other changes in pensions, taxation, mentioned earlier, salary sacrifice, it just makes VCTs, to some extent, but also EIS, far more interesting for people affected by normal financial planning. Because all this talk about gifting, people putting money into trusts, that can also cause capital gains. So people selling properties, people selling businesses. If we see more exits in EIS, then we would also see more people selling other businesses outside of EIS, because that's a good sign for the economy. And so I do think next year could be a really interesting year for EIS.
Yeah. One would hope so. Kealan.
Well, the EIS, following on what Ewoud said, the budget was quite good for EIS in certain ways. I'm a little bit surprised, I think, as I said earlier, about that they didn't extend the investment period from, say, 10 years for a KIC to a bit longer, because they've increased the limit so much. But I think it's good news for the EIS. I think it's no secret it's been a tough funding environment the last two and a half years, whatever. It continues to be a bit difficult. But I mean, the big change that Philip alluded to is moving the 30% income tax relief down to 20% for VCTs, which, although they're different markets, I think VCT is much more of a retail market rather than a sort of, a typical EIS person maybe sold a business or is a business person or whatever. We're not looking at basic rate people who were looking for tax-free dividends. But I think it will be good for EIS. There will inevitably be some spillover. Whether that happens before April 5th or not is another question, but certainly long-term. So I think, whether it's Q1 or throughout the year, it's going to pick up for EIS. Bear markets do not last forever. I mean, just like bull markets do not last forever. Brad, you and I have been around a few times. We've seen a few of these. And there's always a point in a bull market where you're going, oh, when does this bubble pop, And it's the same with the bear market. Like, what's going to happen that causes this to come back? I don't think this is going to be a stonking year in terms of everyone's going to rush to EIS, but I think it will improve. I think there will be improved exits, which will lead to improved sentiment. So I do think we're going to have a pretty good year this year in the market generally, not just Symvan. So, yeah, I'm relatively optimistic going into this year.
Yeah, I think I'm mildly positive. I think my concern is about the ability of EIS to fundraise. I think it's been really struggling now for 2, maybe 3 years. And, the improved company limits, very nice and very helpful, but I don't know if they really attract more people into this asset class unless you have an economy that feels stronger and people who are more confident about, taking risk in their investments.
I think the talk of the improvements for the entrepreneur do not feature that much in the conversation with the investors, especially not advised investors, where we are looking at other aspects of their financial life that continue on. The fact that an EIS fund can invest in the next round is not going to change the need to make the investment in the first place for the investor. So
So it sounds like cautious optimism, but definitely a distinct amount of caution out there, I think would be how I would summarize that perspective.
Well, what I would like to see for next year is a breakthrough with the ability for nuclear in the UK, and that actual proper shovels in the ground. I mean, maybe that's too optimistic, shovels in the ground next year for nuclear, but at least that planning permissions are going to be granted for more stable and cheaper electricity long term. Because that's something that a lot of businesses struggle with, right? With high energy prices.
Yeah, I think manufacturing, AI is going to need it more and more. They definitely need, I think you don't need to dig far. It's not really something EIS is going to benefit, or VCTs are going to benefit from directly, but indirectly, it would make companies a lot easier.
With the small form factor solutions, and there's a lot of technology that goes on in that sector now with alternatives to uranium. So I'm hoping that there's going to be a lot of technological solutions coming out also in the UK and not just in other countries where they are going ahead with a lot of developments there.
Well, that would be nice to see. Anyone else got something positive to think about for next year?
I think there's two things that are coming. So this year and last year, I suppose you'd say, was dominated by everyone talking about AI, without a doubt, right? It was overwhelmingly the topic on everybody's mind, and for good reasons, some bad reasons as well. But for it definitely, and that's not going to go away. I think this is the year that we'll start seeing separating the wheat from the chaff, if that's the correct phrase, with AI. But I think there's two trends that are kind of flying under the radar. Not really, but I think this will be immediately apparent to people, but they're not what people are really talking about the two prevailing trends for 2026. But I think both of them are relevant. One is European defense spending. We have made some investments, and we're looking at a lot of others. There's clearly a massive shift towards increasing defense spending, and a lot of that involves, everything involves AI these days, but much more. And so that, I think, the increasing investment money going towards defense, European defense, that is, across the board. I think that's one of the major trends. And I think the other one, although the UK is lagging a little bit, is tokenization. We're involved in a group called Conduit, which is mostly American, but we have a UK company that's part of a consortium. 15 companies came together. It's a really big play. And it's in the most interesting area of tokenization, because just like, again, you and I are long enough in the tooth to remember you remember when people used to refer to internet companies? When was the last time you've heard someone described as an internet company? But a lot of them were nonsense, as you remember, but some great companies came out of that period, like Amazon and, Google and whoever, eBay, etc. But a lot of failures. And we tend to think of tokenization, or crypto, as it's more popularly known as Bitcoin. Bitcoin has its role in the universe, but tokenization of real assets. And by real assets, I mean, to start with, property and bonds, fixed income instruments, and then leading to everything, basically. It'll become all pervasive. So those are my two predictions for this year. I think that at the end of this year, we'll all be talking a lot more about tokenization and about defense spending.
Yeah. Okay. Philip, you got any predictions for next year?
Not really more than what has been said. I mean, there's always going to be new invention. There's some great ideas coming out because we are a great nation of entrepreneurs and innovators. So it's always encouraging and refreshing when you see that the companies that come across through us. I would hope we get less uncertainty and fewer leaks about what may or may not happen. I think that's damaged business confidence. So my chief ask to the government is, let's have a strategy. Let's know where we're going. Because that's only can build confidence both for entrepreneurs and for investors.
We'll forward a copy of this to the Chancellor to let her know. I think my prediction for next year is actually going to be the same as last year, because it's a pretty safe one this year, which is that we'll have more exits. I said that 12 months ago, and I'm very pleased to say I was right. And I believe we're going to see more in the next 12 months. I think it's a market that I think, as Philip was saying earlier, the vendors are more willing, and I think there is a supply of cash out there. So, I'm definitely optimistic we're going to see a few more exits in the next 12 months. So on that note, I'd like to thank Philip, Kealan and Ewoud for being part of the year-end panel. And I said, big thanks to Philip for stepping in at the last minute. It's very good to have you as part of the panel. So I'd just like to finish by wishing everybody a very happy Christmas, and you have a very prosperous and successful 2026.
Thanks, Brian, and the same for everybody else.
Thank you.
Thanks, everybody.
Thank you.
I hope you enjoyed the discussion as much as we did. As usual, you can get full show notes with links at harmonandco.com/podcast. You can subscribe to the podcast on all good podcast services or players, or through the link in the show notes. If you like what you hear, then please tell a friend or colleague, or give us a review on your favourite podcast app. We can be contacted at inquiries@harmonandco.com. Thanks for listening, and we'll be back in 2 weeks' time.